So once you want to cycle out, let's say it's a generation later, I'm assuming what other measures can you implement for minimizing the tax burden if you want to cycle out within one generation versus deferring it to two generations later?
Yeah, I mean, you could go try to buy more real estate and do some cost seg on a $20 million deal, right? So you could try to, and you could try to get some cost seg, accelerate 25%, 80% of this is could be building value. And then that means, and of that next number, let's just say 16 million of that, 25% would be accelerated in year 1, 2, or 3, of which that might be, I don't know, it could be potentially 4 million. And then you could try to call it in that same year and then try to exit at the same time. So you have a wash event over here and over here. So, or you had a loss. Let's say you bought a deal for 20 million and you sell it for 16 million. So you had a loss. So the key is tax optimization. Take the money when it makes sense for you. Okay. The other way to pay for this thing has to do with income tax, right? So Amy might have a very high income and maybe not enough depreciation to offset. Like I had a client, he makes $1 million a year and he's mid 40s. And he's like, Brett, I don't need or want any income from the trust. I'm like, okay, let's delay the trust from paying you for a couple years. And therefore his income tax went lower. Okay. He had another client, the one in Colorado, a $5 million deal, multifamily property. There were $25 million. Their motivations for this was, I don't want to touch any of the money for 4 years. So they delayed the payment for 4 years. They live in California. They had no depreciation on this property. So they were taking it was fully depreciated. So it was taking all the cash flow and they're just paying all the tax. So their goal was move all the equity into the trust, defer all the tax, but also defer the income from the trust. Let the trust just compound. The trust can act like an IRA in this scenario, in that all of the growth of the income and the capital gains from the investments can compound and grow. It operates in a tax neutral state on most years. Therefore, it's just growing tax free, and the client's not receiving any of that capital or any of that cash flow, and therefore their income tax is going lower. Does that make sense?
Yes.
Okay. So that's a powerful way. They can also establish residency in Florida or Texas or Tennessee or Nevada. Once they establish residency, I had another client move out of Palo Alto, moved to Nevada. Then he starts taking payments once he's in Nevada. Guess what? California, huge income tax. Nevada, zero. Okay. Now, it doesn't mean he can dip into principal and pay zero. It's still gonna follow him, right? If he dips into principal, he'll pay the capital gains tax of California, but the interest payments are ordinary income tax. So you delay, and then start pulling him out. So that's the second way to get the trust to pay for itself. Okay, the next way is moving the funds outside your taxable estate. So back to my client who was worth $25 million, all of that $25 million was basically all in real estate, and all of it was inside of their taxable estate. And they're in their mid-60s. At 25 is likely to get to 50 million, perhaps by the time they pass. But above 22 million married right now, 40% of whatever is inside your taxable estate is going to be hit with whatever is above 22 million is going to be hit with a 40% death tax. It has nothing to do with stepped up basis, nothing to do with capital gains tax. It's everything to do with your estate tax. Okay. And so for them, they looked at this as an estate planning. Oh my gosh, 2 million on one deal in one day without buying life insurance, without buying not doing charitable remainder trust. They sold, moved it into the DST, moved it outside their taxable estate. So that's the other way to make this thing an investment rather than an expense.